Hi, Richard.
Hey.
How you doing?
Are you dry yet?
Almost.
Oh my gosh.
Did you have any landslides?
I had two.
No way. Are you serious?
I had two landslides, yeah.
What?
I was
That's
looking around like,
joking.
hey, we survived it okay, because we're on top of a hill here.
Yeah.
And all of a sudden I went and looked Monday, and it was like, oh my gosh, two landslides. We have these two French drains, and all the water from the house goes on down the hill.
Yeah.
And it was like they broke and just.
Oh no! Oh my gosh!
It's going to cost a fortune to fix.
No. Yeah, I lost a gazebo, like one of those Lowe's kind of fabric ones. It shredded in the wind and rain.
Really?
My neighbor's texting me, there's a problem with your gazebo, and it's a total eyesore to her. You know,
Why don't you pay attention to your own
house, are you
house,
gonna take
buddy?
that down?
Gosh, that's
like,
crazy.
I'll get to it. Okay.
That's wild. Wow.
What a week. Gosh.
It's been really crazy. Yeah. What's this mug here you got?
Isn't it cute? Well,
yeah.
Well, I guess it's time to tell everybody. I have a thing for mugs. They make me really happy. So today is the no drama llama. I don't know if everybody out there can see it, but inside, every time I take a sip, it reminds me, no drama.
Awesome. It doesn't really fit you very well, though.
Hey, what are you trying to say? But we are talking about the drama of the markets today.
We are. That's right. So welcome, everybody, to A Place of Possibility. I'm Richard Del Monte.
And I'm Angela Wright.
And we're glad to have you here. Sorry.
Hey, that's my line.
Okay, all right, fine. So what are we talking about today?
Okay, today we are talking about how to structure your investment portfolio to meet your goals.
Right.
Also known as asset allocation.
Asset allocation. Yeah,
yes.
Right. So how do we begin?
With the end in mind.
Oh my gosh, there she goes again. Okay, well, that's your thing.
Seriously, I say this all the time. You're going to get sick of it. Begin with the end in mind. Your time horizon is one of the most important factors when considering your investment allocation. In order to select an asset, you need to know what you want it to do.
True.
Do I want it to grow really quickly over 18 years so my kids can go to college? Mm-hmm. Do I want to stash some cash aside so I can buy a house in 3 years? Or maybe I need some kind of income stream because I'm not working anymore. Like, what do I need this thing to do? Only then can we start talking about how to invest these assets. So if you're at home, hit pause, write down a couple of financial goals and a timeline, and then let's start again.
Okay. So you're saying, like, if I'm saving to change my oil down the road or something, I shouldn't put it in stocks.
Exactly.
A short-term thing. Okay.
Yes.
Go on vacation. All right.
Yes.
All right. So we want to talk a little bit about what the basic, the building blocks that you have are to build an asset allocation, right? And that's what the investments are that you can put into your portfolio. And we're going to rank them from the lowest risk to the highest risk, relatively. And so they start with cash, bank accounts, T-bills, things like that, which basically have no volatility. They can't go down in value. They're guaranteed by the government. But on the other hand, they don't make much money either.
Right. I think we're sitting at 0.01% in
right. It would take you 40 years right now to make 1%. So that's kind of where we are. Not much return, but they can't go down. Okay.
Yes.
Then the next level up would be government bonds, and including Treasury inflation protected bonds or securities called TIPS. And so those are investments guaranteed by the government, but they're a little bit longer term.
Let me back up. For those of you who don't know the difference between, let's say, a stock and a bond, we'll really break this down for you today.
Great.
So a bond is loaning somebody money. So I give, let's say, the government $10,000. There's a time horizon. They'll pay me some interest, and then they'll give me back my $10,000. You're lending money out when you're purchasing a bond.
Right. And so like a mortgage is a reverse bond, right?
Yeah, totally.
Honestly, yeah, for sure. Yeah,
exactly.
Right.
So you can get them from the government. You can get them from municipalities, like your state, your city, for example. And you can get them from corporations.
Right. Those are the three different kinds of bonds.
And we just listed them in order of risk.
Right. So government first, muni second, risk is a little bit more risk because we do know that some municipalities fail.
Sure.
Right. And then corporate bonds. And the higher risk of the corporate bonds are the ones that are riskiest, and those are called junk bonds. Mm-hmm. But they're not junk, folks. Those are just high yield bonds that pay a higher interest rate because the risk is higher. But typically, if you look over the last 30 years, junk bonds have done very, very well in returns. Yeah, for sure. Okay, so then going up, we have stocks. We start getting into the stock, and did you cover stocks, equity?
Not yet. So stock is equity in a company. Just like with your house, go back to that example. Yep. You have equity in your home. When you buy a stock, you have equity in this company. Really tiny amount, but you've got it.
Right.
So it's ownership.
That's why they call them equity. So stocks and equities are interchangeable.
We're going to do that to you a lot today.
Yeah, right.
Interchange those terms.
Yeah. So you have large company stocks in the U.S. Mm-hmm. And those would be things like Walmart, Apple, Google,
GE.
Tesla now,
Yeah.
the biggest one's
Yep.
$1 trillion market cap this week.
Yeah.
And then you get into small company stocks, or called small caps, small capitalization stocks. And those are usually companies you've never heard of.
Yeah.
Like a thumbtack company that's in Boston or something.
Some guy in his garage.
Yeah,
well, maybe you're
that's a
out of the garage.
microcap
By the
company,
time
right,
you're
right.
small, you're publicly traded, a small company, you're out of the garage.
Yeah,
but
right. But it's
still,
in this, it's the bottom 20% of the size of companies typically is the classification for small caps. So those are U.S. ones. Then you got large and small companies in foreign.
Overseas.
Foreign companies, right? Like, so in the developed markets.
FYI, the United States is not the only place where you can buy investment assets.
Right. Most people aren't aware of that for some reason, but we only have like less than, I think, around 40% of all the market cap or stocks in the world. Publicly traded stocks.
Yeah. So if you don't look out, you're missing out. Totally.
Right. So large and small in developed nations, and developed nations would be like Japan, Denmark, France, England, right?
Exactly.
Big ones, okay? And then we have the emerging markets, and you have large and small companies in the emerging markets. What would be an emerging market?
It's got Philippines, a lot of Latin America.
Right, Russia, Middle East, things like that.
Yeah.
Really risky, but typically the returns are higher over the long run.
Yes.
Next up, the risk is what we will call commercial real estate. I'm not sure that commercial real estate is actually riskier than stocks, but typically you have fewer holdings in there, so they are.
Anything from a liquidity standpoint too. So we're jumping away from equity stocks now, and we're going into real estate.
Right.
Okay.
And so the safest way to do that is in real estate investment trusts, which you can own through mutual funds and exchange traded funds.
Yes. We'll talk more about how to do those in a minute.
Okay, good.
Yeah.
All right. But real estate, and then gold and precious metals is another one that gets higher. And would you say that people should be putting gold bars underneath their bed?
Yeah, sure. Great idea.
Yeah, really good idea.
No, please don't do that. I mean, it's the old way, and I know that there are entities out there right now recommending that you buy gold bullion and put it under your mat, under the bed. I mean,
or
that's
Krugerrands or coins.
So
or whatever.
I mean, I just think from a safety standpoint, that can be stolen. It could be burned in a fire. I mean, if you live in California, you don't keep your money in your home. Hello. I mean, it's just, and the commissions that you pay to buy and sell actual gold bullion.
They're clipping you for like 8 to 10% on the buy side and on the sell side.
You never pay that sales commission on a mutual fund.
Right.
Why would you pay it on a bar of gold?
So you got to pay you got to make 20% in this thing before you even break even when you pay for the commissions. Yeah. So don't buy it personally, even though they'll scare you to death and say you have to have it because we're coming, the end is coming. You can still do the same thing with a mutual fund or an ETF.
Exactly.
Okay. Then higher up on the risk scale, we have commodities.
All right. We hear about them on the news all the time. For normal people, what is a commodity?
So these are tangible assets like timber, oil, gas, cotton,
pork
grains.
Bellies. Why is it always pork bellies?
Pork bellies.
Like we're eating all of this pork belly in our country.
Well, bacon. Sorry.
Bacon. That's right. Belly, that's a very important commodity around here.
In some places it's really important. Yeah, right. Not so much here, but in my house. But so those are commodities, and the reason that those would be some portion of a portfolio that you would consider is because they're really good inflation hedges. This year, commodities are way up.
Yeah.
Way up. They're doing really well. So then you have individual real estate. So these are things you would actually buy yourself, a rental house, a second home, a strip mall. Yeah, if you got that kind of money. But it's riskier because it's so much money and it's in one property.
Yeah,
right.
Exactly.
Okay.
Liquidity as well.
Then private lending. That's a good one, right? So you loan money to your kids as an investment or somebody else.
Someone starting a business, for
Micro
example.
lending. You want to talk about that?
Yeah. So micro lending there are all these outfits set up to give money to small business owners in emerging markets. But we were talking about Philippines, et cetera. And you're lending to these super tiny business owners. Right. And it's amazing because it provides a lot of opportunity in those areas. And your returns are through the roof, but also high risk, right?
Yeah,
it's like, one woman in her home making baskets.
Whatever, something in her community.
Yes.
And so it's high risk. It's funny that the failure rate on those is not really that high.
It's not. No, it's an
amazing.
interesting area of investing. If you have, we're going to talk about speculation in a minute. If you have some extra money, it's a cool place to go.
Right. It's something because you're doing good by doing good.
Yeah.
Right. For other people, doing well. Okay, the next one after private lending is private equity. These are basically investing in companies that are not trading on the open markets. Yep. And there's a lot of places that can do that, but you have to be really careful because not everybody can get into them. You have to have certain income levels. You have to be what's called an accredited investor.
That's right.
Okay, then the last one, the highest risk would be speculation. These would be your
Well, you could speculate on a lot of things. The cryptocurrency, for example, your Bitcoin is considered, it's not a stock, it's a speculative asset at
Not
this
a bond
point.
either, right? Yeah, for sure.
You know, maybe you're investing in your new friend's new software company, that's speculating.
Right.
Even GameStop right now, it's technically a U.S. equity, but right now I would say that's a speculative investment because no one's investing based on the fundamentals of that company.
Yeah,
They're investing on what's happening on Reddit.
They're not planning to own it for 30 years. It's like, will we own it in an hour from now still? That's speculation.
Right,
okay.
Exactly. So there's a place for that, certainly.
Right.
Okay, so Rich, I've decided... You've listed out all of the different investment possibilities for me, and I've decided, like, I want a stock. It's what everyone else is doing anyway, so I might as well do it. How do I pick the right one? Or 10? Or, like, what do I even do?
How about 10,000?
What?
How
am I supposed to pick 10,000 stocks?
You do it through a mutual fund or you do it through an exchange traded fund. It's really so.
Tell me more.
So the meat of your portfolio, the biggest part that you're going to rely on for most people should be in professionally managed funds. I'm not saying by us necessarily, but by a mutual fund family or tracking an index or something that's diversified, because then you have not only just hundreds, but you may have thousands of stocks in each mutual fund or ETF, right? So that gives you lots of diversification, right?
Right. It reduces the risk. We were talking about in real estate, you own one home, it could catch on fire. Now you own nothing, or you have insurance money, I guess. But it's same with a stock, right? If one company goes broke in your mutual fund, you still have 9,999.
You wouldn't even know it, probably.
No, of course not.
Yeah.
You would never notice something like that. And so you've got, hundreds to even thousands of securities in one mutual fund.
Whereas if you had all your money in, your neighbor's startup and it goes broke, you're in big trouble. Right. So that's the difference right there.
Yeah. So there are a lot of people out there that believe that, they can outperform the market buying stocks and bonds themselves. Like there has to be, you can't just invest in mutual funds. That's for pedestrians. I'm better than that.
Too boring. Yeah. Right.
But what's interesting is this outfit called Dalbar does a study every year. They've got like decades now worth of studies. The average equity investor compared to just the S&P 500, and in 2020 they lagged by 2%, and it's always somewhere in that like 2 to 6%. The average investor who's investing in equities, the same thing the S&P 500 is made up of, is failing.
And that's over a 20-year period, right?
Yes.
They lag by that much.
Yes. Yeah.
Right. And why would that be? Why might that be?
I mean, there's behavioral issues, right? The market goes down, you become afraid, and you sell.
Right. Or you get too greedy. It's way up now at all time. I think I'll buy now. Okay, good.
Yeah, exactly. Other timing issues. Maybe you trade too much and you cost yourself in taxes and trading fees. I mean, there's all sorts of things.
Yep. So stocks are super volatile. That's the next level of diversification is holding a lot of different asset classes, right? So you want to have large cap, small cap, mid caps, U.S., international, blah, blah, blah. Yeah. Bonds, different kinds of bonds, cash, things like that. And you want to do that because the other things will dampen volatility.
Yeah. Wait, define volatility for a second.
Well, that's how much things go up and down. You know it when you see it, right? It's like pornography. It's hard to define, but like basically if you get you open up your statement today or you look on the market and the stock you just bought is down 50%, that's volatility.
Yes.
Right? Yeah. That's an example of it,
exactly.
Right?
And
nobody minds upside volatility. If it went up 50%, you're a hero. If it's down 50%, you got a problem. Right?
And that's not uncommon to see in stocks, especially if you're investing in small companies. 50% up and down throughout the years.
Yeah, it's really
expect it.
Now bonds on the other hand, they rarely go down more than 5 or 10%. Typically in a year. So that's why mixing them up, you basically get a portfolio that's going to be a lot less downside. 50-50 stock and bond, you won't have a 50% downside. Maybe now you only have 20.
Yep. Yeah.
So
it's kind of like, we use this analogy, like stocks are like spicy food. It can be kind of spicy. It could get really spicy. Yeah. And bonds are kind of like, dumping some sour cream on top of that. Yeah, they dampen the spice. No, it's got to be milk.
Does it?
Yeah,
I didn't know that.
Anybody who eats spicy food knows you have to have milk or something creamy. Like water's not the same. No, or a big scoop of rice will help too.
Okay.
Anyway,
well, good. So a third level of diversification is basically with respect to correlation of returns.
Okay, now we're gonna have to define correlation here. Okay. So we were just talking about how stocks can they go up and down, right? So correlation is how your asset, stock, bond, mutual fund, etc., moves by comparison to another asset, right? So a negative correlation would be yours goes up, that one goes down.
By the same amount, 100% negative correlation would be just like this,
yes.
Up and down.
They can go together, they can go apart, digging, zagging. So why is this important?
Because you don't want to, you want to have assets that will give you a much smoother ride. So if you have 10 different assets that are negatively correlated, which honestly is not really possible, they have some that are less correlated with others.
Yeah.
That's really in the real world what you can get, but you end up getting a much smoother ride overall.
Right.
It's like having shock absorbers on your car. You're not going to get as much of a bounce.
Well,
and so
a real world example of this would be like when oil. Right.
Okay, good.
You can buy things that are inversely correlated. So let's say there's an oil shortage, right? What's going to happen to oil stocks during an oil shortage?
Skyrocket.
Woo, there they go, right? What's going to happen to your airline stocks during an oil shortage?
Yeah.
So that's one event, an oil shortage, but you have diversified your assets properly so that your ride through that craziness is just a little bit smoother.
Yep, that's a really good way to describe it. Exactly. I love that. So you want to get assets that will zig when other ones are zagging. That's the way to think about it.
So if I buy, so we've talked about why I need to buy mutual funds and ETFs over individual stocks because I can get, like 10,000. So how many what if I go buy 3 mutual funds? Now, am I good to go?
Well, that's a really good question. Maybe, but most people probably not. So if you bought, it depends. So if you bought, let's say the Fidelity, the Vanguard 500 index, and you bought Fidelity Contra Fund as an example, and T. Rowe Price Growth.
Okay. 3 different mutual funds.
You might think I've got diversification there. Wrong, because they basically have the same stocks inside of them all. Yeah. So you basically have 3 times of one thing. They just are basically overlapping.
So I've tripled down on the same thing.
Yeah, you triple down and you don't have any diversification at all.
Oh my gosh. And that can be kind of tricky, right? Because let's say you have like the Fidelity Contra Fund, for example. What's even in that?
Well, basically they would have large cap stocks. Yeah. And a lot of tech.
And how would you know?
And in the S&P 500 is basically large cap stocks and a lot of tech. And T. Rowe Price Growth. That's where a lot of the juice is these days, is in tech. Mm-hmm. So that's why you don't get much diversification. So you want to make sure that you have large cap stocks, and you want to know which funds do that, and small cap stocks, and all the other things we talked about.
U.S., international,
and emerging markets.
Bonds.
Right.
Corporate,
and different kinds of bonds.
Government.
Corporate, government, right.
A little bit of everything.
So how, that's, you want to make sure you're not overlapping.
Yeah. And along those lines too, like if you're investing in real estate, so this is if you have an asset that's not in an IRA that you can't just diversify into a mutual fund, but I'm investing in real estate, you can diversify geographically. Right? I wouldn't want to own all of my rental properties in the Bay Area. Pricing.
Why not?
Pricing is a huge concern. I don't want any here, but pricing is a concern. But you've got legal issues in California. You have weather things. You've got different industries, different types of renters.
Right. Risks.
Yeah,
fire,
different risks.
Earthquake.
Exactly.
You want to have everything be in the
I have one rental area. In a college town, for example. If the college goes under, that rental's I'm done, right?
Right.
So diversifying geographically can be really important
Makes a big difference. I like how you transitioned into that too.
Thank you.
That was good. Okay.
We're getting better, Mom.
Okay, so how do you decide how much to put in each asset class, Angela?
Next level. Well, it depends on your goal.
It depends. Imagine
I say that in such a snarky way, but it really does, right? If your goal is to buy a house in 5 years, we're not going gangbusters on small company stocks because, as you know now, they're very volatile. That said, there are some best practices around retirement investing, and we will give those to you. However, big old disclaimer, we don't know you or your personal situation, so please talk to an advisor before you just blatantly,
Yeah, we're going to give you, generally speaking, this is the rule. So if you're a young person that's under 30 years old and you're investing for retirement, which for you is maybe 35 years away, potentially, right? At least.
Yeah.
You should probably have about 100% of your money in stocks, equities.
For sure. Yeah.
And why would you say that? Because they go down 50%, Angela. Why would you do that?
Yeah, but like you just said, you have 30, 35 years before you're touching this money. Technically, if you're 30 years old and you're putting money into your 401k plan, you cannot access that money without a penalty until 59 and a half. So you have so much time to make up for those little dips in the market. You would really be shooting yourself in the foot if you didn't go all in on that.
Right. And the other thing is when the markets are down like that, when they do go down by 40, 50%, which is rare, but it does happen.
Yeah.
You're putting in money every week, every month, whatever. And so you're taking advantage of that. It's called dollar cost averaging, another whole topic. But, you're actually buying low when taking advantage of those things. You're not sitting there with a big target on your back suffering. And you should not get out. We know people that get out of the markets, or their neighbors are doing it, or their guy in the next cubicle is doing it. No, do not do that. That's you're shooting yourself in the foot.
In fact,
okay.
In a minute, we'll tell you what to do when that happens.
Mid-career. That was the young people. Mid-career, 30 to 50 years old.
This is me.
Probably should be. You probably should have somewhere around 80 to 90% of your money in equities. More if you can stand it.
Yep.
If you can tolerate it, personally. But again, you have time. You still have time.
Oodles.
At least 15 years. More like 25, 30 years.
Yeah.
Late career, 50 plus. Until retirement, 60 to 80% equities. Again, this starts getting a little bit more on you're getting close, and your personal risk tolerance actually has a bigger impact because you start getting scared more at older ages. Like, ooh.
It becomes so much more important. That
baseline
bigger, right?
number. You have a lot more money.
Yeah, true.
Maybe you have $1 million or $2 million, so it's like,
30% loss is suddenly $300,000.
Right, it's not my $10,000 I had when I was 20. Right?
Yeah.
Exactly.
Totally.
But the concepts are the same. It doesn't really change just because you have more money. So how about if you're retired?
So this is where it really becomes choose your own adventure because there are best practices. 40 to 70% of your assets in equities. And we'll talk about why you need to do that in a moment. But you can't run away from equities once you're retired. But that's where, it comes down to your gut at the end of the day. If you can tolerate that 70% equity, go for it.
Yep.
If you are like, oh, please, no, I can't, then maybe closer to 40% for you. But again, it's coming back to your own risk tolerance.
And you never want to have less than 40% because you need an inflation hedge, right?
Yes.
To take out.
Nice segue.
Nice segue. But I got to give you the Kevin Kelly quote first. Okay, I got to do this first before we go to that segue. People really, when it comes to risk tolerance, people often fixate on the short-term volatility and they miss the long-term, right?
Yeah.
So this quote from Kevin Kelly, I'm going to analogize it to what we're talking about here. So he said, he's the founder of Wired Magazine, and he says, bad things happen fast while good things take longer. If newspapers and websites were only updated every 50 years, they might report literacy is up, longevity increased, violence is down, and we would add the stock market is up 29,000% over 50 years, which is the average return it makes over 50 years. Yeah. So that's what people miss when they're owning stocks. They're too focused on, the trees versus the forest or the short-term gyrations, and they miss that you're making 29,000% for a whole investing career.
Ugh.
Why would you miss that? That's the path.
Because fear.
Besides owning real estate,
Yeah.
that is the biggest, the most obvious and easy pathway for most people to create wealth.
Yeah. But there's a lot of misinformation and there's a lot of fear. And so one piece of advice that I give to people that come into our office and say, I just can't tolerate when the market goes down. I hate it.
Yes, you can.
Well, what I like to say is think of it like a sale. Right? Macy's has a sale. What do? You run to Macy's and you buy your Christmas gifts, right? I mean, so think of it like the market's on sale. And the way I behave when something's on sale is I run towards it. I buy more, right? Versus running away from it. So if you can give yourself that simple mindset shift, it will change your investing experience tremendously.
And your future, your very future, the success of your financial life, for sure. Okay. So people really should have more, based on what we're saying here, people should really have more equities or stocks than they think, really, because that's where the wealth is created over the long run. But they have to teach themselves to live through the inevitable bear markets that happen. Yeah. Or corrections, whatever.
That's really what separates the wheat from the chaff in investing is the people who, stay the course and in fact make moves when the market is down.
Right. Our best trained clients basically say, I don't look at my statements when they come in the mail during a bear market. We go, hooray, that's great. You get a sticker.
It's how to maintain your sanity.
It is, right. But because there's nothing valuable in that. Because you've lost money, in the short run, doesn't mean that you've made a mistake or that you have to do something about it.
Yeah.
Okay. All right. Another factor to consider, inflation.
Yeah.
Right?
Yeah. So, we got to contend with this animal called inflation.
Yeah.
I mean, this is why we bother with investing in the first place. Like, why would I put my money and myself through all of this if I didn't have to grow it for some reason? And that reason is inflation. the cost of items that we buy increase over time.
And we're seeing it in big time in spades this year, right? You see how much cars have gone up and everything else, gasoline and all kinds
6%
of
for the year.
6% on average. But the long term has been about 3.5% of inflation. And if you have all your money in safe things like, the bank, how many years? It's going to take you 120 years to make 3.5%. That's what inflation is in 1 year. So you cannot, it's not mathematically possible to do well by having safe money.
Yes.
You're going backwards. You might think, well, I didn't lose anything. Right, but you've actually lost 3.5%. This year, you would have lost 6%.
Yeah.
Right? In real terms, in real purchasing power by being in the bank. So you need to have some money for short-term savings and stuff. And, if you have to write a check for an emergency. But other than that, no.
Yeah. And getting back to like retirement asset allocation, inflation keeps going during retirement. And in fact, we've talked about this in a previous episode about saving for your retirement. And yes, it compounds. And so that's why we advocate for 40% at least in equities once you're retired, so that you can continue to maintain your standard of living. We're not even talking about increasing it yet.
But we want you to increase it.
Of course.
Yeah, for sure. Right. Yeah. What about personally owned real estate?
Okay, yeah. So we've been talking all of this game about diversification, but if I'm buying houses that cost, $500, $1 million each, that's really hard to diversify. So we talked about diversifying it, geographically. But I like real estate because you can also think about diversification in terms of your income sources. So let's say I'm retired, I'm getting Social Security, I've got my retirement portfolio, and then maybe I own a rental property. So like 30% of my money comes from my Social Security. I don't know, 60% of it comes from my retirement portfolio, and now I've got 10% coming from my real estate portfolio. This is a really cool way to think about your retirement income because your Social Security is steady, and yes, it is steady. And your retirement portfolio, your investments might bounce around. Well, in really, down stock market years, or if let's say you have 3 or 4 down years, your rental income often stays the same or increases during that period.
Right.
Like 3 to 5% on average, we see increases in rental income. So that's a diversification of your income sources.
Right. And the value of the home may hold it.
So you're also an equity investor when you're investing in real estate. The equity of your home can increase as well.
Yeah, that's right. So it is a diversifier for sure.
Yes, don't forget about those assets.
Right. Absolutely. It's a really good diversifier. Okay. So rebalancing.
Okay, so we've gone all the way through, like, what are the assets? How do we allocate them? How much of each thing do we need? Why should we even bother? And then can I set it and forget it?
No, because your 60-40 portfolio will end up being 80-20 in 10 years.
Why?
Well, because stocks will, the reason you have stocks is because they grow 10 to 12% a year, right, on average. So if you have like 60% in stocks at getting, 10% and 40% in bonds getting 3% or 4%, at some point the stocks are going to grow much faster and become, well, you had a good analogy, right?
Yeah. So for my non-money people, and if you happen to garden, think of this like mint in your garden. The equity, the stock is the mint. Eventually it's just going to take over your entire garden.
Mint takes over everything?
Mint takes over oh my gosh, you plant one mint seed and your entire backyard will be filled with mint.
Yeah.
And so that's a good analogy for the way equity takes over proportionately in your portfolio. So what you have to do is rebalance, AKA trim back some of that mint and make room, buy some bonds.
Buy some more bonds, right? As your portfolio.
Or some other, some other asset.
Right.
But,
so there's different ways of doing that, right? Some people do it annually, the rebalancing, quarterly, and there's always been a big question like, what's the best way?
Yeah.
Yeah.
I bet you have an answer to that question.
I do. We both do.
Imagine that.
As you know. We found that a study done, kind of a landmark study was done recently, about 10 years ago, and it found that if you opportunistically rebalance, which means you don't just do it on a regular set schedule, but you're looking for opportunities to do it, and you only rebalance when a particular asset class either grows by more than 20% or it declines by more than 20%.
Ooh, interesting.
So let's say you have 10 different things and each one is 10%, just to be simplistic. If one goes from 10 to 12, you would trim it back to 10. If it goes down to 8, you would buy more and bring it back to 10 again. By doing that consistently over time, you actually add 0.75% to your returns.
That's amazing.
That's amazing, right? That's free money, folks. That's a gift from heaven. That's the best way to do that, and that's something that we do automatically for our clients.
Oh, absolutely. Right, a couple of things you want to be careful of when you're rebalancing your own portfolio. If you're not in a retirement account, watch out for taxes, right? Because an asset has gone up, you have capital gains now. So you need to be careful about that. And also trading costs. If you want to be rebalancing all the time, there are fees to buy and sell securities, of course. And
it's called friction on your portfolio.
Yeah,
right?
friction.
Taxes and fees are friction.
Yes.
Right? Yep. Right.
It's we just covered so much.
Very, very. But it's an important topic, right? And so you want to get your own personal portfolio to be in what we call the Goldilocks place, right?
The Goldilocks. It's not too hot and it's not too cold, and it's just right for you and your goals.
Right.
Your goals.
And that just right for you needs to be based on real facts, not fears, not unfounded fears like, oh, the stock market's going to go down. My brother-in-law told me, this is real stuff like, based on, where you are.
Okay.
And unrealistic fears of short-term volatility can be really harmful to you. You really have to understand that they're part of the process. Like it rains here. We just got 10 inches of rain. Sorry, that's what it's like living in California. Yeah. Drought to rain in one day.
I think if this is something that you're struggling with, if you happen to be watching a lot of the news, I would encourage you to pull back on that because, every day they're out there, blah, 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 scary this, terrifying that. This is all going to where. I mean, shut up. Yeah. It doesn't matter, honestly, in the long run, especially if you're only opportunistically rebalancing. Then you're only paying attention to the overall movements, not these day-to-day little gyrations in certain companies or political movements are now a whole thing in the stock market. Shut it off. Ignore it.
Our next guest is going to be the guy who predicted the last, and he's saying that the market's going to go down by 50% soon. Those are the guys that, and I actually say that some of those, the financial news channels are the equivalent of investment pornography.
Totally.
Because they appeal to the worst aspects of you.
They really do.
And they make you want to make emotional decisions, and that is like poison to success. Yes. Do not listen. I mean, they're filling up time. They have to, right? If you're talking every moment by moment on television, you're only focused on the next 5 minutes. Exactly. But that is not important. It's white noise.
Exactly.
Right.
Yeah.
Okay.
Maybe interesting, but it's not important.
All right. How about some questions?
Okay, let's see.
Are there any questions?
I have, how do I know the mix of my mutual fund? Oh, yeah. So we were talking about if you own the Fidelity Contra Fund, how do you know what's in that?
Yeah, right.
That's a really good question.
Yeah, I mean, so basically you can go to some sources. You can go to like Morningstar.com. You can go to Google, right? And Yahoo Finance.
Yeah.
And they will actually give you like what's called a portfolio X-ray, and see what's in the portfolio, right?
It's pretty neat, actually. So every mutual fund has what's called a ticker symbol, or you might see it QSIP. It's a 5 letter.
We talked about this earlier.
It's a 5-letter symbol that you can enter into Yahoo Finance, and like Richard said, it'll bring up an X-ray, and it's cool. Like, there's even a little box where it will chart are you small or large cap? Are you U.S. or international? And you can see what's actually in these funds that you own.
There's also the easy way, like you brought up. If it says Fidelity Small Cap Fund, it's probably a small cap fund.
Yeah. Sometimes it's in the title of the fund, PIMBO U.S. Bond Fund.
Yeah, right.
That's obvious, and you can trust for the most part if it's in the title that's what it is. If it's not in the title, then you got to go look it up.
Yeah. How about there's a question about age-based investing in those life cycle funds?
Oh, yeah. So in your 401k plan,
right,
yes. These are getting really, really popular. You might see something like age-based or retirement target date or life cycle fund. Right. And what those do is they automatically rebalance your portfolio to be more conservative as you get older. So we were talking about those mixes that you should have. This does it automatically for you. So if you're the type of person that really does not want to touch any of this, that's a good way to go, right? Yeah. I mean, it'll keep you in kind of the right spots, throughout your life. However, they get too conservative too early. So if you look at some of these funds, by the time you're 50 years old, you're heavy into the bond territory. Right. You're much less than 40% equity, like we've been talking about, and it's just too conservative. I mean, half of our retired clients wouldn't even have a portfolio that conservative. Right. So I think while you're young, they're really great. Like if you want to ignore it until you turn 30 and then swap out into a better allocated portfolio that you regularly rebalance. Right. A lot of 401ks will do it for you. Now there's buttons you can push, like rebalance me every 3 months or so you don't get the opportunistic, but you can still rebalance.
Right. If you really like those ones and you're getting close to retirement, you could just say pick a target date that's 20 years from now, and you'll have probably a pretty good balance.
Yeah.
Way to get around
That's
that.
a great hack for those.
Yeah, right, for sure, yeah.
Good job.
But if you pick one that says, I'm going to retire in 2023, you're probably close to zero equity right now, which would be a disaster.
If you have that, go look at your target date.
Yeah. Okay, so anyway,
I think that's it for questions. Yeah,
Okay.
let's wrap it up here.
All right, so we want to make sure that you know that we have our ebook that's available, and it discusses exactly one of the topics is this.
Yes.
And
Evidence-based investing insights.
Evidence-based investment insights.
You can get it from our website.
Our website. Right?
Yes.
And then we also want to let you know that within a week or so from now, we're going to have our Know Your Possibility guide that will give you a step-by-step template to run on for this podcast to see what topics you need to cover. And then also, if you'd like to have a consultation with either Angela or I about your portfolio, we have free 30-minute consultations. You can get them on our website. And the fourth thing is, if you have any questions at all, we love to take questions and answer them for you. So you can email us at info@aplaceofpossibility.com.
You can also suggest topics for future podcasts.
Yeah, we'd love to get more future topics. We get great ideas from people on our topics. So anyway, thank you very much for being with us today. We appreciate it.
Thank you so much.
And
this was a fun
remember,
one.
you're invested, and so are we. So thanks very much. Take care, folks.
Bye.
Bye-bye.